Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is October 8th, 2017 edition of Market Outlook. Well, the first thing I want to note is that our risk on, risk off gauges are showing risk on. And in fact, if anything, and we'll get into it in detail, things are definitely improving as well here. So first thing to note, I want to drill down to the weekly charts and look at our real motion gauges here because they're telling a pretty important story. So looking at the weekly charts, first of all, you can see, of course, we've got the 10-week, which is the magenta line here. The 50-week is the blue. This is the 200. And if you look across all of the indices, they're all in gear. Can't argue with that. Now, the key thing is, of course, looking at momentum. And our bottom charts here, or the bottom graphs, are our real motion indicators that tell you about the strength of the trend. So a couple things to observe. Number one, you can see the strength here after all of this sort of compression on the IWM. We've been pointing out you got a really strong breakout. This is some of the strongest momentum, clearing that 200-week of real motion. Now, the other thing to note is on the Dow, DIA, our 50-week cleared the 200, and on an absolute basis, our real motion indicator is showing the strongest momentum, right, surpassing what was sort of the highs back in 2015. That's clearly different than the broad-based S&P 500, which is still substantially lagging. Same thing you can say for NASDAQ as well. Even though a NASDAQ is up on an absolute basis, the most on the year compared to the others, it's still quite a distance off in terms of pure momentum, looking back to 2016. So net, what can you say? Small cap stocks represented by the IWM exhibiting the strongest momentum, and the same thing on the Dow on the weekly chart. So big cap, value stocks definitely gaining strength along with small cap. So those are your two big themes, and there's some interesting short-term patterns that I'm going to get into on the IWM on another chart as well. Okay, let's look at our next set of charts here. So the next set is taking a look at the S&P versus utilities, which is a big risk on, risk off indicator. And one thing you can certainly see here is that it's quite powerful in terms of the overall trend. The S&P, right, definitely in a strong position relative to utilities. This is a utility chart here, and as you can see, we're actually in a warning phase, and you got that sell-off, which really commenced starting somewhere in here, and you've got, right, a weakness in the S&P, strength back in here, and that shows relative weakness in the utilities, and that's a good sign here because, of course, utilities, more conservative play, very interest rate sensitive as well, but speculative money, hot money, definitely coming back into the market as utilities are indicating here. Utilities weak, equities, U.S. equities, bottom chart here, as you can see, well above the 50-day moving average, nicely in gear. Now, taking a look at some other key ratios, which is part of our risk on, risk off indicators, and you can see across the board, risk on dominates, right? Versus bonds, the S&P outperforming and continuing to outperform. High yield debt versus the TLTs, the 20-year, also moving up strongly. So people willing to take on risk versus gold, same scenario. S&P outperforming gold by a wide margin. And again, lumber, wood ETF also outperforming. And again, just there's the chart of the S&P in gear. So our key risk on, risk off indicators definitely in positive mode. Taking a look at sectors, what's interesting in the sectors is, of course, the strength of semiconductors, still hot. It was sort of iffy. They basically resumed its leadership after a bit of a sell-off, and again up 1.7% for the week versus 1.3 for the S&P, outperforming. Technology outperforming as well. And the next thing is that financials picking up the rear. But again, the top three here, healthcare, technology, semiconductors, all leading. Now, what's also interesting to note, you've only got two sectors that are down net, consumer staples, conservative plays, definitely lagging, and of course, energy. But that definitely looks to be basing out. And as you can see, over the last 3 months, you've got a move of plus 6%. So it's actually been keeping a slightly better pace than the underlying S&P 500. So that's looking pretty good. But net, you can't argue with the fact that pretty much all of the sectors are having positive returns pretty much over the last 6 months and the last 3 months, and certainly year to date. So good participation across the board, with the exception of retail, energy, and of course the more conservative plays, which would indicate risk off, consumer staples, still, as you can see, mostly down over the 3 periods that I just mentioned. So overall, there's no warning here about what sectors are leading or lagging. In fact, if anything, it's all in confirmation. Now, in terms of volume analysis, also, you've got a scenario where you've got very few distribution days. So as you can see, accumulation across the board, all the key indices, have 4 accumulation days. Russell has 0 distribution. The one that's having a more of sideways or iffy action regarding the volume is the S&P. But net, if you took the aggregate of volume here, it's extremely positive across the board. So this big price move here for the year, for the month, for the week, along with volume here, can't really argue with what's been happening. So all that is in gear. So now let's take a look at a couple of the commodity plays that I had mentioned, because this is certainly something that has been on my mind. Commodities, again, extremely cheap relative to stocks, and certainly that's a comparison based on over 100 years of history. So some of these things are basing out. So let's move to those charts in a moment. Actually, before we move on to some different charts, what I wanted to point out is IWM, because it's got a very interesting compression pattern that is very, very tradable on the short term. So even if you haven't participated in the upside, there's a real opportunity. So the first thing to note here is this is the IWM chart. You've got this interesting compression over the last 4 or 5 days, digesting this huge move up. Of course, just to reiterate, one of the things that we had pointed out at the end of August is that the relationship between the IWM and SPYs, IWM started really gaining traction versus the S&P off of our triple play indicators. And that was occurring right here, pretty close to the bottom, and right just beneath or around the 200-day moving average, and it really shot up. So now you've got this scenario where you've got compression on this leading index at the moment. So a little bit of sideways action right over here. And what I would be doing is certainly placing a stop right around this 148 level, or even if you wanted to play it a little bit tighter, right around 149 or so. So this whole compression zone here should hold, and if you get another breakout above the recent highs, you could get another interesting leg up and acceleration. And support definitely should come in and using it as a stop as around the 148 to 148.50 level. So there is your best setup on the indices at the moment. One other thing you might want to take notice is you do have an inside day pattern in the S&P. So playing along with the trend would be playing above the high on Friday, which comes in around 254.50 or so. So you could definitely play a short-term pattern, which is the inside day pattern with a tight stop. And again, important support certainly comes in around the 250 level. If you're more of an active trader, right around 251.70 is the 10-day moving average. So two good short-term patterns. IWM, the better of the two because of the tight compression. All right, now let's take a look at some commodities. So the first thing I want to point out is DBA. This is agricultural ETF. It includes a whole bunch of agricultural commodities here. And so a couple things to note. You can see here, right, our real motion indicator moved down pretty sharply in alignment with the move down. You got another new low and you basically matched it on momentum. Now the key thing here is you got a significant new low in here. You did make a new low in momentum, but not at the same magnitude. Now what's also important is this level right here, right, is an important swing point. And we've now moved above our 50-day moving average. Additionally, you can see that we've gone sort of sideways on our triple play indicator versus the S&P. So we haven't really lost much ground at all. So that to me is an overall positive. In addition, if you look at copper, copper's been really strong. Actually, you've got a breakout on real motion and also a pretty decent move off the lows starting in the middle of the summer or late summer. And you got a really nice move. And copper is often an indication of good economic activity. So this is a very, very meaningful bounce. I like the fact copper has been overall pretty strong. You got a really nice bounce over the last couple days. Let's drill down to the weekly charts. And you can see just how powerful, using our indicators here, that the copper has been. So again, nice breakout, right? You move from a low of 24 up to 36. You can see on the weekly basis that we've got a real breakout of momentum. And relative to the S&P, you're just really starting to get some decent relative strength. So even with the big move up in S&P, since the lows here, copper has been doing quite well. Now, the other thing to note is, again, on the weekly basis, look at this. You've got this point right here, this one right here. You've got the 10-week moving average where you're just starting to trade above. So you sort of got this base that formed, and now you've got a lot of people trapped totally out of the agricultural game here. So as you're starting to pick up and move through this swing point, that's pretty important. And as you can see, on a weekly basis, even as we've been trending down, we've basically been staying sideways, and now we're picking up. If we can get up just a little bit higher, you would sort of have a momentum breakout and sort of a breakout of this downward move here, which could mean a much larger move to the upside. Now, what I want to do is also talk about the base in cocoa. So I'm going to switch charts here in a moment, and hang on. So this is cocoa. This is a commodity not all that widely followed. This is an ETF that trades pretty decently. So a couple things to note, and I think this is indicative of the overall situation in commodities. And so this chart sort of mirrors a bunch of things that are going on. First, we've moved above the 200-day moving average for the first time in quite some time. Also, take a look at our real motion indicators. So momentum definitely turning positive, right? We've got our 50-day of real motion over our 200 and just starting to trade now for the first time above the 200-day moving average. So momentum definitely stronger, and you've sort of got this interesting wedge and base pattern here. Now, that's on the daily chart. Plus, on a relative basis, our triple play indicator is cocoa definitely breaking out for the first time in quite some time over the performance of the S&P. So that's saying quite a bit as well. And if you take a look, here is the weekly chart on cocoa, right? And this goes back, you can see it was as high as 50 back in 2011. It's less than half price. And again, our 50-week moving average of cocoa just right above all of this compression. So you got an interesting potential breakout here. As you can see, our triple play indicator that we use versus the S&P, basing out, looking for a potential explosive move here. So with all of this compression, both on the daily charts, the weekly, things are definitely lining up. Now, of course, this is definitely bottom fishing, but you know, commodities are extremely cheap on a relative basis compared to equities. So anyway, there you got some good ideas across the board. As you can see, stocks still in gear, running a little bit rich, but still in gear. And of course, another place to go is in this commodity sector. And I'll be covering more of this and more individual commodities as we move forward and things start playing out as we expect. Hope this helps. Bye for now, and see you next week.